I have a confession to make. I've opened 12 credit cards in the last 2 years. That sounds a lot worse out loud. And if I'm being perfectly honest, I'll probably open a few more in the not so distant future. I want to make it clear I am financially and mentally sound, I think. I never run a balance and pay everything off at the end of the month. Why would you do this, you may be asking? To me, I find it incredibly fun. Credit cards are my Blu-ray collections or Pokemon cards. Earning like 80,000 rewards points with the introduction bonuses on every card I open fills me with what I think is joy, and it pays off. Over the last 12 months, I've gone on trips to Vancouver, Chicago, New York, Switzerland, Japan, subtle flex, most of which had their flights covered by credit card points. It's gotten to the point where I'm making Excel spreadsheets, tracking intro bonuses, and planning on the most optimal strategy to spend to get the most value for my points. I've fallen down rabbit holes online, finding threads of people doing the same thing, and it's got me thinking, how is this whole thing possible? Why do credit cards give away free stuff? Is the whole system of YouTube channels and Reddit pages optimizing credit card rewards purposely designed to keep me engaged in the system? If so, why? And who's doing that? You always hear such horrible stories about credit cards, but I'm having a pretty great time so far. I feel like I'm waiting for the shoe to drop, but I don't know how or when or if it ever will happen. So come with me on this journey as I try to figure out what's going on here, because I have no idea. I hope that looked good. It took a long time to set up. To start figuring this out, we have to go back to the beginning. The first version of what we would consider a credit card had its roots in the 1920s. These were metal slates called charge plates. They were issued by department stores and gas stations to allow customers to make purchases and settle the bill later. But in 1950, everything changed with something called the Diners Club card. You may have heard of this. There's versions of it around today. A guy named Frank McNamara forgot his wallet during a business dinner and decided to make a charge plate that would work at multiple restaurants. The card was originally given out to 200 of Frank's friends and acquaintances. But by the end of its first year, they had 20,000 members, and by the end of the decade, they surpassed 1 million. I think this is the part where I tell you to like and subscribe. Did you do it? Okay, great. In 1958, we see the next rung on this ladder form when Bank of America does something unthinkable today. On September 18th, 1958, 60,000 residents of Fresno, California opened their mailbox to find something called the Bank America card. This was an already activated credit card giving every single recipient a $500 credit line. No application, no warning it was coming. They called it the Fresno drop. As you may have guessed, the move came with its own set of risks, like people just taking the card out of the mailbox, using them, and never paying it. Despite these problems, the card was a massive success. It was the first call to use something called revolving credit. Remember this term because it's the foundation of almost every credit card on the market today. Instead of having to pay your balance off in full at the end of the month, you could carry something called a balance, where you didn't have to pay anything back by the due date. You just pay interest on that money. Let me be clear, this fundamentally changed how people spend their money. Using debt to finance everyday purchases was foreign to a lot of people, and this was the first tool many had to try it out. Okay, back to the history lesson. Turns out giving a bunch of random strangers lines of credit wasn't a great idea. Over 1/5 of people who got a card the first year claimed delinquency. This cost Bank of America over $20 million of losses in the first year. $20 million in 1950s money. A bunch of banks were watching what Bank of America had done. Despite being an insane marketing tactic with crazy early losses, over 2 million cards have been issued in a year, and they started to turn a profit not too long after. A few of these banks decided to get together and form a group called the Interbank Card Association. Super creative, I know. They started making their own cards to compete, changing their name to MasterCharge and eventually MasterCard. Bank of America saw this growing competition and decided to follow the same business model. They licensed out the Bank America card program to other financial institutions, and by 1970, they decided to give up direct control and spun it off into its own company named Visa. It was quickly becoming clear there needed to be some new oversight, so 3 companies filled up to fill this demand. You may have heard of them: Equinox, Experian, and TransUnion. They began compiling data and introduced an early version of what we call the credit score today. Now, it's important to realize a lot of people went a long time without realizing their spending was being tracked and quantified. That affected their ability to get loans, housing, and their employment. The lack of transparency and understanding about how these scores were calculated and how they could be corrected hurt a lot of people early on and even today. You may be asking yourself at this point, why would someone willingly choose to pay for something they couldn't afford? Especially in the 1960s when most families could afford everything they wanted on one salary. Now, that's a very valid question, but the second part was about to change. By 1974, women were finally able to get their own credit cards, just in time for inflation to completely drive up the cost of living. Several factors, including oil embargoes, low interest rates, and huge amounts of government spending on new social programs, and the Vietnam War, were leading to double-digit inflation rates. Stuff was getting expensive fast, and credit card companies began looking more and more appealing. Just, until the inflation goes down. This period lasted well over a decade, accumulating in a recession by the early 80s that put a lot of people out of work. The stars had aligned perfectly for a wide-scale credit card adoption for the first time in history. Now cut to the mid-1980s. Sears, the largest retailer in the United States at the time, decided to launch a credit card. The landscape was vast by this point, and they decided they needed to do something different to stand out, something big. Enter the Discover card. This card had no annual fee, which was uncommon at the time. The killer feature, though, was something called cashback bonus. For the first time, you would get a percentage of your purchase back, between 1% and 5%, depending on how much you use the card. So here we are, 4 successful card companies, and a few recessions later. Somewhere between then and now, a whole infrastructure was built that made it seem like living in this country without a credit card was now the weird thing to do. When did that happen? After the invention of the cashback card, every other credit card company caught on, and by the early 1990s, everyone had their own version of cashback cards. And some had even begun using points. These were different from cashback. They could usually only be redeemed for things like merchandise, travel, or gift cards, but they tended to offer higher value, if you were willing to learn the game, that is. These tactics, combined with co-branded cards from airlines and hotels offering their own reward structures, made cards way more appealing for people who otherwise would have never touched a credit card. Up to this point, whenever you had to pay your bill, you either had to write a check and send it in the actual mail, or go down to your local branch of whatever bank the card was through and pay in person. That wasn't until the 90s saw the advent of online banking. This completely changed how people interacted with their cards. And now you could use a website to view your statements, pay bills, and monitor your transactions digitally. This made a card much simpler, and paying with cash seemed like more of a hassle for the first time. Fast forward and we see the last few bits of innovation in the space that took away whatever friction remained with paying on card. The early 2000s brought contactless payments through RFID chips, and the emergence of mobile wallets in the last decade with Apple Pay and Google Wallet have taken that tech and run with it. Now, a technology that upends commerce to the degree these cards have is beholden to one almighty power. We all know them: congressional banking committees. This was a group of congressmen dead set on reining in the more, shall we say, manipulative practices in the industry. The first of these laws was the Truth in Lending Act. Passed in 1968, it required companies to disclose all relevant information when you open a card. Those little white papers that you get in the mail, that's where those come from. There wasn't much passed in the subsequent decades. It took until 2009 for the next notable piece of legislation. In the wake of the financial crisis, a newly elected President Obama and Congress passed a bill called the Card Act. This law significantly reshaped the credit card industry. It strongly enhanced transparency, requiring credit card companies to be much clearer about interest rates and other fees they try to tack on in the background. It limited a bunch of junk fees and made it harder for these companies to prey on consumers under 21, requiring co-signers for most applications in this group. These changes have made credit card companies pivot into data analytics companies. American Express is a great example. People who use American Express cards tend to have higher incomes and spend at higher levels, which makes the data of these consumers extremely valuable. By selling this data to advertising agencies, Amex makes money. Similar practices can be found at MasterCard. They also use a ton of information in-house. If you've ever gotten credit card applications and targeted offers in the mail, you are the target of algorithms. If it's from American Express, I would take that as a compliment. Discover it? Not so much. Well, how else do these companies make money? There are 4 main ways: interest fees, interchange fees, annual fees, and junk fees. Let's break them down quickly. Number 1, interest fees. This is the one everyone knows. When you miss your due date for your payment, some cards allow you to roll over the amount until you pay it off, with a fee, of course. With standard interest rates of about 22% in 2024, if you roll over a $1,000 credit card bill, you can expect to pay the credit card company an additional $220. And that's just for the first month. It compounds over time into what some people call a death spiral. Number 2, interchange fees. When you use your credit card for purchases, stores pay a percentage of that transaction amount to the card issuer. These fees typically range from 1% to 3% of pretty much everything you buy. Some cards offer much better benefits than others, but tend to charge an annual fee for the opportunity. 2 of the most popular American Express cards are the Gold Card and the Platinum Card, coming in with annual fees of $325 and $695 respectively. Number 4, junk fees. Junk fees are basically a catch-all for all other fees the cards may charge you. These include late fees, cash advance fees, balance transfer fees, foreign transaction fees, and more. Now, it's important to note that these tend to show up more on cheap cards, while ones you pay an annual fee for tend to be more streamlined and less sketchy. You may notice a trend with these fees. they feed on poor people. If you have some extra money in your checking or savings account, you don't have to worry about interest fees, late payment fees, or cash advance fees. Fees for the most part you wouldn't even worry about in the first place if you had extra money to spend on the card with $300 annual fee. Not to mention that the expensive card has got crazy introduction bonuses that get you enough points to fly to Hawaii. And the only thing you needed to do was spend $3,000 on it in the first 3 months. These companies make it very clear who they want as clients, and they make it very scary if you try playing the game with less money than they want you to have. But at the end of the day, this kind of looks like a game, right? The rules are complicated, sure, but there are roads to get those rewards points without losing a bunch of money in fees. If only there was some place I could go to learn more. I'm gonna walk you through my introduction to the world of credit cards. Imagine this, you just graduated high school and are about to start college. A lot of changes are going on. Most of them make you feel like an adult for the first time. You may have heard there's a bunch of stuff you get to do when you turn 18, but all you remember doing since your birthday was registering to vote and joining the draft. You Google things you can do at 18, scroll past the obvious and not so nice stuff, and you see open a bank account. It seems like a very adult thing to do, but you don't know where to start. After all, you don't want to mess anything up, as going to adult prison was the next thing on the list. So you go to YouTube, you find some finance channels that answer your questions, and eventually find yourself watching a bunch of videos by a guy named Graham Stephan. One of his videos really captures your attention: the millionaire investing advice for teenagers. I'm a teenager, this is perfect. The first thing he tells you to do is get a credit card. Why, aren't credit cards bad? He says it's to raise your credit score early. A part of your score is something called length of credit history, and it gives you a higher score the longer you've had an open line of credit. Then you find another video on his channel called the 5 best credit cards for beginners. Suddenly your entire YouTube homepage is flooded with other videos like this. You find channels like Credit Shifu and Ask Sebi, and now you're off to the races. I want to make a side note here. One of these finance YouTubers is named Caleb Hammer. He walks people through their finances and tries to help them get better. Anyway, he has this great clip with a guest where he says, you are not
a credit card person. You're not even close to a credit card person.
There is absolutely truth in this. Despite what these finance influencers say, not everyone has the temperament or foresight to use these cards responsibly. I am far from a financial advisor, but if watching these videos is making you want to open a credit card, try it out. It can be a great move if you play the game right, but if you pay even a single dollar, a single cent in fees or interest, I would strongly recommend cutting yourself off from the ecosystem. In some ways, these companies really aren't that different from casinos. They feed and manipulate your biological tendencies to make you justify bad decisions. You should never have to know the interest rate on a credit card. You should never know if you can transfer your balance. If you can't afford something, please don't put it on a credit card. The second you're in the red dealing with them, it's time to pull out. You lost the game, and that's okay. Not everybody is a credit card person. But if you could stay and watch the rest of the video for the algorithm, I would very much appreciate it. Not every video is going to be about credit cards. We're going to do some other really interesting stuff, I hope. Back to the topic at hand. These creators often talk about advanced strategies for maximizing rewards, which some call travel hacking. It involves leveraging these credit card sign-up bonuses, using reward point multipliers, and strategic spending to earn free or discounted travel. They teach techniques like using cards for certain purchase categories. For example, the American Express Gold Card gets 4 points back on dining and groceries, but if you use the Chase Freedom Flex for gas, it gets 5 points back during the summer. Other influencers teach something called manufactured spending, which is when you find new methods to artificially increase your spending when you can't reach the spending goal on a certain card. They usually do this by putting business expenses on personal cards or paying your taxes early on a credit card. While it can be an effective strategy, it's risky if you don't know the rules, which is where the influencers claim to help. If you go farther down the rabbit hole, you'll probably find yourself on r/credit cards and r/churning. These are pretty active communities of people who like to ask questions, share personal experiences, and offer advice on credit card use and strategies. Here you can find pretty sophisticated discussions on credit card churning. This is the practice of repeatedly opening and closing credit card accounts to take advantage of sign-up bonuses. It can be profitable in terms of the rewards you get, but it can really damage your relationships with these financial institutions if you do it incorrectly. As you'll be able to tell by spending any time on these sites, the practice of credit card churning has not gone unnoticed by any of these credit card companies. They've implemented new rules to clamp down on it. For example, a few years ago, Chase Bank introduced the 524 rule. This restricts people from being able to open any Chase credit card if you've opened 5 or more cards in the last 24 months. Similarly, American Express now has a once per lifetime rule on all their cards. It means you can only get the sign-up bonus for each card once in your lifetime. You may think these rules aren't all that harsh, and you'd be right. After all, 5 credit cards in 2 years is still a lot, and American Express has a bunch of different cards you can churn through. The important thing to know here is these methods were designed to slow people down, not stop churning. The idea that people can game the system is really attractive. If you clamp down on it, no one will open new cards. The fact of the matter is that over 80% of Americans have credit cards, and many are open to getting more. The game is winnable, but the banks hold a lot of cards. No pun intended. They know it only takes one financial misstep for a concerningly large number of Americans to fall into debt. And these companies know that they'll be the first place people turn to. If you take away one metric from this entire video, please let it be this. As of the second quarter of 2024, the total number of credit card debt in the United States is $1.14 trillion. It's the highest level since the Fed began counting in 1999. I genuinely have a split view on these financial influencers. On one hand, they can act as a guide for people going through a purposely hard to navigate ecosystem. On the other hand, they naturally play into the allure that credit card companies spend billions on every year in advertisements. One thing you can't deny though is that they're changing the landscape for everyone. People are more literate on their finances than ever, but they're still falling into the same traps that have been set for decades and in larger numbers. I don't know what the solution is. Does it start with influencers, credit card companies, the government, or you? I don't know what the future holds for any of this. If you were to ask me what the effects of the growing financial literacy in the country and the popularity of financial influencers was, I'd say credit card debt would be at an all-time low, but it's the opposite. These companies have never done better. Amex stock is at an all-time high, and so are Visa and MasterCard. Two companies, I should say, that are being tried by the federal government in one of the most substantial financial lawsuits of the 21st century. Look it up. But for the sake of argument, let's try and guess where things are going by looking at the things that made credit cards what they are today: changing technologies and government regulation. The next 10 years will see more and more people using their cards exclusively on their phones. This will change how people view credit cards, moving from a physical piece of plastic you carry with you to just another button on your screen. The history of credit cards shows us that debt skyrockets when things become less affordable. Whether or not the current affordability crisis gets worse over the next 10 years might play into this as well. We may see more politicians advocating for even tighter regulations and restrictions on these cards. This could lead to a snowball effect, where these companies make less money as a result of the new legislation, causing them to cut back on rewards, causing less people to use their cards until there's nothing left. At the end of the day, I think what I've learned is that this is a messy industry. It's one where you can make out with free plane tickets or spiral into a death spiral. The history of these cards is plagued by exploitation and weird business practices. And despite that, it's turned into a really strange game with some winners and a lot of losers. Whether or not you choose to play is up to you. Just make sure you do extensive research before getting in, and don't let Graham Stephan make the decision for you. I've found a few YouTubers that I found give really great financial advice below. Please check them out if you're looking for a place to start your finance journey. Do you have any interesting credit card stories to share? I feel like most are either boring or incredibly sad, but if you have something interesting to share, I would love to hear it. I've got a bunch of ideas for videos I'd like to make in the near future, but I'm kind of flying blind. If you have any comments or input on this style of video for me to use in the next one, I'd love to hear it. Yeah, okay, I'm gonna stop talking now. Goodbye.